Stop what you're doing right now, this second. Tell your dog you will walk him later. I do not care if you're in the shower. Get out and grab a towel. This is more important than whatever you think you're doing right now. We've grabbed your attention, and with good reason. The silver market is literally on fire. Shanghai silver has exploded to an eye-watering $104 an ounce, while Western prices stubbornly trade around the low 90s, a $13 premium that defies belief. In late January 2026, the Shanghai Gold Exchange spot price of silver surged to triple digits, peaking just above 100, even as New York's COMEX futures lingered near $91. In one trading session, what does that mean? Think of two massive markets at opposite ends of the world seeing completely different prices for the same metal. Normally, arbitrageurs or physical shipments would snap that gap shut. If silver cost $104 in Shanghai and $91 in New York, traders would buy cheap COMEX silver and ship it to China to sell at a profit, closing the difference. But in reality, something is blocking that normal flow. For the first time in modern memory, supply and demand imbalances have become so severe that Shanghai traders are paying vastly more. It signals a dire global supply crunch and an east-west decoupling of metal prices. China has tightened the screws on silver exports. As of January 1st, 2026, only 44 Chinese companies are even allowed to export silver, up 2 from 2025, but still a tiny share of production. The government classifies silver as a critical metal linked to national security and now strictly controls its flow. In practical terms, Chinese industrial users and investors are fighting over limited domestic stock. Meanwhile, Western traders must source metal abroad under new hurdles and costs. The result? Shanghai pricing on silver, which reflects real physical demand, is hitting record highs, driven by electric vehicle, solar power, and industrial demand, all sectors that use silver heavily. On the flip side, Western prices, NYMEX or COMEX, though at historic highs themselves, can't keep up. These futures markets trade mostly paper silver, and they haven't yet caught the full force of the global squeeze. As the world now pays through the nose for actual silver, a $13 spread suggests real stress. Banks, producers, fabricators, and mines are struggling to source metal at any price. The ramifications for global markets are huge. That wide premium tells us that physical silver is essentially more scarce in the East and that global inventory is evaporating. For context, recent data showed registered COMEX silver stocks plunged dramatically. Over 60% of the available COMEX silver inventory was claimed for delivery in the first days of December 2025. In 1 week, supply buffers were drawn down by more than half, as if traders suddenly decided we're taking delivery and pulling metal out of warehouses. The result was deep backwardation, meaning spot cash prices far above futures prices, a hallmark of extreme scarcity. navnurbawa.substack.com. This is no normal bull market move. It's a crisis brewing. And at the center of that storm are the banks, the big bullion banks that for years have been on the wrong side of this trade. Back in late 2025, researchers found that a handful of major banks held enormous net short positions in silver. In fact, just before the year-end surge, 17 big non-US. Banks were estimated to be collectively short over 215 million ounces of COMEX silver contracts, a colossal value. That's hundreds of billions of dollars of notional silver on the short side. These banks were effectively betting silver would stay low. Instead, it's doubled and more. As prices exploded in December, those short positions became toxic. Banks faced margin calls, demands for more collateral at lightning speed. On Christmas Day itself, physical silver jumped above $80 in Shanghai. Trading resumed on COMEX that night with silver gapping from the 70s to the mid-70s, and by New Year's Eve, it had climbed near $80. In that period, one report noted banks tapped the Fed's emergency repo window for over $75 billion by DEC. 31 to cover year-end liquidity crunch. That massive Fed intervention hints at how stressed the system was getting around the silver chaos. Then came the most telling sign: rumors and news of a large bullion bank failing a margin call on a massive naked silver short. By January 2026, traders were buzzing that one major player had lost the ability to cover its silver bets. It was reported that right before markets closed on a Friday, somebody dumped a $429 million wager on a junior silver miner ETF, SILJ, through near-term call options, a 3-week bet that silver would soar. The narrative was that this bank, unable to deliver on its massive short at $80 silver, was desperately hedging by buying enormous call options on miners, betting that silver would keep shooting higher. In essence, in 8 minutes before close, someone made a $429 million long bet, an almost unheard of single trade volume, on silver miners, presumably to offset incoming losses on its short position. That shows just how dire the situation became for these banks. Put plainly, Some banks are trapped. Their short positions, which at last summer's prices were manageable, have now blown up. With silver up 100% plus, they would need to pony up enormous amounts of cash to roll or exit those contracts. If they try to cover by buying back futures, they'd simply send prices soaring further. If they default, the CME clearinghouse might have to liquidate their positions, also sending shockwaves through the system. Essentially, the major bullion banks are either scrambling to find capital or preparing for fire sales. Neither scenario is friendly. The whole finance industry is watching, worried that a big default or forced liquidation could spread instability. Meanwhile, the CME group and clearinghouses are doing their best to keep the bridges from burning. In December and January, margin requirements on silver contracts were hiked repeatedly. By year-end, the maintenance margin on silver futures was up to about 9% of the notional contract value, a steep rise from roughly 7.2% just a month prior. Then, on January 12, 2026, the CME announced a new rule. Margins will henceforth be calculated as a percentage of the contract S notional value, not as a fixed dollar amount. In effect, as silver's price goes up, all participants must lock up more collateral proportionately. That was designed to stabilize things by ensuring the clearinghouse isn't left hanging on huge moves. But it also means every bank or trader paying attention must now set aside a much larger cash buffer for each contract. So far, these margin hikes have applied to everyone, not just shorts, but they've squeezed the already levered players the hardest. If banks have been comfortable with $50 silver at 5K margins, $100 silver at 9% means 10K margins, double the capital needed, hitting P&L and raising the bar for continuing to hold the trade. How are other investors reacting? It's a mixed picture. Among retail traders, enthusiasm is raging. Online forums, trading subreddits, and financial media are buzzing with silver mania. Everyday investors are snapping up physical coins and bars, or piling into silver-related exchange-traded funds and mining stocks. Demand for physical product, even at steep premiums, is through the roof. For example, by mid-January, the Sprott Physical Silver Trust, PSLV, an ETF backed by real bullion, was trading around $32 per share with year-to-date gains near 30%. That's nearly a threefold rise in recent months. It was under $10 last year. Trading volumes in these products have exploded. Social media is lit with proclamations of finally getting in on the squeeze, showing bags of newly minted bullion and congratulating each other. It's reminiscent of the last big mania. Back in January 2021, stocks like GameStop, except this time the commodity is silver. Many retail buyers are in it for the thrill or as a hedge. Some compare it to digital gold or even cryptocurrency and its institutional investors. And funds, however, have been more cautious. Interestingly, some data shows Western-listed silver ETFs have actually seen net outflows during the latest jump. In January, as prices raced higher, reports noted about 7.9 million ounces worth of silver flowed out of U.S.-listed silver ETFs. Why? A leading analysis observed that this suggests demand is primarily coming from Asia, especially China, or from leveraged players, not from traditional Western investors. In other words, big money here in the West isn't adding new long exposure via those ETFs. Instead, more of the buying is happening in Shanghai's market or in OTC markets. Institutional commodity funds do remain bullish, though. A few large bullion funds and commodity desks have been signaling record bullish positions in silver and gold. Some hedge funds have started scooping up shares in mining companies. As silver equities have surged, one chart circulating online shows silver miners rallying hundreds of % this year. On the institutional caution side, some big names in banking are hedging their bets. A month earlier, a major brokerage reportedly lost over $2 million trying to close a short position on COMEX silver, illustrating that even professionals were caught off guard. Central banks and governments are quietly watching as well. Note that Russia's central bank has been aggressively buying gold and possibly silver recently, and China has added silver to its strategic reserves list. Some reports even mention Chinese banks imposing extra restrictions. They've reportedly suspended new silver futures accounts and raised margin requirements on Shanghai's exchanges around October-November 2025 to slow down speculative outflows. This time, it seems both retail fervor and some institutional caution are fueling price pressure, a classic 1-2 punch. For perspective, let's recall previous silver manias. There is historical precedent for these fireworks and for their aftermath. The most famous is the Hunt brothers saga of 1979-1980. Two Texas oil billionaires cornered the silver market, driving prices from around $6 an ounce in early 1979 to nearly $50 by January 1980. Almost a 700% rise. They leveraged heavily, buying physical and futures. It ended in March 1980 with Silver Thursday, when exchanges changed rules and silver crashed by 40% in a day. The Hunts went broke and banks reeled. If you lived through it, The parallels are eerie. Soaring prices, skyrocketing margin calls, banks besieged, and promises of a historic squeeze until panic and policy intervention turned everything on its head. Another example. In 2011, silver ran from about $10 in 2003 to roughly $50 by April 2011. Many investors still remember that peak and the painful fall that followed when gold headed down in 2013. Although far from a corner attempt, 2011's rally was driven by global economic fears and massive bullish positions. It caused regulators to launch investigations into possible manipulation. Though not a short squeeze in the same way, it reminds us that once frenzy sets in, corrections can be brutal. Less often cited but instructive was 2008-2009. As the financial crisis hit, silver fell initially, but then rebounded spectacularly in early 2009. And in 2020, during the early COVID crash, silver plunged to the mid-12s, but then shot up to over $30 by mid-2020 as stimulus and gold fever took hold. Each of these episodes showed that when the market's confidence in traditional assets shakes, flows into safe metals like gold and silver can surge, often in volatile, parabolic moves. Every time, traders who bet too aggressively on the other side got hurt, whether it was banks shorting or late-arriving bulls jumping in. So yes, the atmosphere is tense and thrilling. Analysts and strategists are now openly debating if silver could hit $100, even $200 this year. A Bank of America analyst was widely cited predicting $135 to $300 in 2026, reflecting extreme volatility expectations. And while that range sounds wild, even seasoned commodity experts acknowledge $100 silver is far from impossible, given current momentum and macro factors. Already in mid-January, one precious metal strategist remarked that once silver is at $90, the difference between $90 and $100 is negligible. He was implicitly forecasting higher prices ahead. Indeed, mainstream financial media now routinely points out that silver is up 100 to 200% year on year, and that any further hiccup in confidence could drive it straight to the triple-digit mark. Emotionally, the market is a powder keg. Retail traders are riding high on euphoria, convinced history's on their side. They see short sellers, and by extension, big banks, as on the run and talk of paper hands versus diamond hands in silver memes. On the other hand, large financial institutions are more fearful of what comes next. Defaults, further turbulence, or regulatory crackdowns. An air of suspicion lingers because, unlike typical commodities rallies, this one mixes real industrial shortage with heavy speculation. The banks feel backed into a corner. Traders feel we might be witnessing a legendary squeeze or the start of a long-feared fiat crisis. Throughout all this, technical market guardrails are being tested. Exchanges like CME have responded by raising margin requirements and switching to percentage-based margins to ensure no single player blows up the clearinghouse. But even that speaks volumes. In a healthy market, margins barely budge from historical norms. Now they're climbing, meaning risk management rules have to catch up with price action. The fact that silver futures maintenance margin is set to 9% of notional, much higher than a few weeks ago, is a stark signal. It means traders of any stripe need to put up much more capital to play silver today. That automatically throttles some demand, since capital is scarce, but it also puts enormous strain on those who already invested. All the while, the underlying fundamentals are screaming shortages. The Silver Institute reported 5 straight years of supply deficits, totaling around 820 million ounces, leading into 2026. Central planners in multiple countries have signaled they view silver as strategic, part of counter-to-resource nationalism, alongside things like rare earths. Power grids, solar farms, and 5G all gobble up silver. When even spot physical traders can't find enough metal, that's a profound signal. And we should not forget, gold and silver often move together. Gold set new records just before, then silver jumped to follow. Central banks like Russia's and China's grabbing ounces, combined with investors fleeing rising debt, add fuel to the fire. In sum, this isn't hype or rumor, it's a real documented market phenomenon. Shanghai's $104 Oz silver was officially traded. COMEX printed its own record. Banks are publicly reported to have paid fines and seen losses related to silver. CME published notices about margin changes. Sprott reports its NAV and flows. Fed balance sheets show repo usage, and mainstream outlets like Reuters and major financial commentators are analyzing these events. There is zero fiction here. For viewers and investors, the immediate takeaway is the silver market has entered rarefied territory. If you hold positions, long or short, you must understand the scale of what's happening. A short position is not just off by $2, it's off by tens of dollars, translating to massive mark-to-market losses. A long position might be laughing now, but must also watch for sudden volatility and potential government or exchange actions. Both small investors and big institutions are watching each other. Will today's momentum continue unchecked, or will something snap under the weight? much like Silver Thursday in 1980. No one has a crystal ball, but the data is clear. Physical demand is through the roof, prices are surging, and old paradigms are breaking. This is a global ripple on every financial pond, from mining stocks to bond yields, from currency markets to inflation expectations. Whether you're a hedge fund manager, a mom-and-pop bullion investor, or a day trader, what happens next in silver will touch your world in ways that are still hard to grasp fully. Stay alert, because the next chapters of this silver story are still being written. If you thought you could afford to ignore commodities or dismiss these moves as another bubble that would pop without consequence, think again. The clock has started on a potential market event that may rewrite the rules of trading in precious metals. And whatever you do, don't take that shower just yet. And here is where the story turns from extraordinary to dangerous. Because when a commodity like silver breaks into triple digits in one major market while lagging far behind in another, it is no longer price discovery. It is system stress. This $13 spread is not a random anomaly. It is a symptom, and symptoms always point to a deeper disease. For decades, the global silver market functioned on a simple assumption, that paper silver and physical silver were interchangeable, that futures contracts represented real metal, that delivery was always possible, if you had the money. That assumption is now collapsing in real time. What Shanghai is telling the world is brutal and simple. We want the metal, not contracts, not promises. And that is the nightmare scenario for Western banks. Because bullion banks are not long physical silver. They are structurally short paper silver. Their business model relied on the idea that most contracts would never ask for delivery, that traders would roll positions, that ETFs would settle in cash, that industrial users would hedge, not hoard. That illusion is gone. In recent weeks, delivery notices on COMEX surged aggressively. Large holders stopped rolling contracts forward. They stood for delivery. And suddenly, the question every clearing member feared resurfaced. Do we actually have enough silver? Registered inventories, the silver that is actually deliverable, fell at a pace that shocked even seasoned metals traders. Warehouses reported withdrawals not seen since crisis periods. Some vaults showed days where outflows exceeded inflows by multiples. This is why backwardation appeared. This is why spot premiums exploded. This is why Shanghai paid $104. Because when physical supply tightens, price is no longer negotiated. It is forced. And that brings us back to the banks. Banks are not evil villains here. They are trapped inside a system they helped build, and now cannot escape. Their silver shorts were hedges, until they weren't. They were liquidity plays, until liquidity vanished. They were managed risk, until volatility went vertical. When silver crossed $70, many desks assumed it was temporary. When it hit $80, they expected intervention. At $90, alarm bells rang. At $100, panic. Because at these levels, losses are not linear, they are exponential. A bank short 50 million ounces at $25 silver is manageable. At $50, painful. At $100, catastrophic. Every dollar higher compounds margin requirements. Every spike forces collateral calls. Every margin call drains cash from other desks. Bonds, FX, equities. This is how contagion begins. That is why CME acted. Raising margins was not about protecting retail traders. It was about protecting the clearing system. By shifting margins to a percentage of notional value, CME effectively said, if silver keeps rising, only players with deep, real capital may stay. This quietly pushes weaker participants out. It forces liquidation, it buys time, but it does not create silver. It does not solve the physical shortage. It only delays the reckoning. Meanwhile, Asia is operating under a completely different mindset. China's demand is not speculative in the Western sense. It is strategic. Silver is essential for solar panels, EV batteries, semiconductors, military electronics, medical technology. China is building infrastructure for decades, not quarters. When Beijing classifies silver as a critical resource, price becomes secondary. Availability becomes everything. That is why Chinese buyers are willing to pay $104. Not because they are bullish traders, but because they must secure supply. And when supply is scarce, price stops being a ceiling. Now zoom out even further. Silver does not exist in isolation. Gold has already broken records. Oil is volatile. Bond markets are unstable. Debt levels are historic. Central banks are cornered between inflation and recession. In that environment, precious metals become more than assets. They become signals. Silver is historically the most volatile monetary metal. It moves last and fastest. When silver explodes, it usually means trust is eroding somewhere else. Trust in currencies, trust in markets, trust in institutions. And investors feel that, even if they can't articulate it. That's why retail participation feels emotional. Why online sentiment is euphoric and aggressive. Why people are saying, this time is different. Sometimes they are wrong, but sometimes they are early. The danger now is not only upside volatility, it is policy risk. History teaches us that when metals markets spiral, authorities intervene. They change rules, they halt trading, they impose position limits, they restrict exports, they settle in cash. We have already seen early signs: margin hikes, account restrictions, trading halts on smaller exchanges. If silver continues higher, expect more. This does not mean the bull case dies, it means the battlefield changes. For investors and traders, this moment demands clarity. This is not a market for blind leverage. This is not a market for emotion-driven entries. This is not a market for ignoring risk. But it is a market for understanding structure, understanding who needs silver and who merely trades it, understanding who can hold and who must liquidate, understanding the difference between paper price and physical reality, because the spread is telling a story of fragmentation, of deglobalization, of supply chains breaking under stress, of financial engineering colliding with physical limits. And that story is not finished, not even close. Whether silver consolidates, spikes again, or faces intervention, one thing is now undeniable. The old pricing regime is broken. Shanghai at 104 Aus is not a fluke. It is a warning that the world is repricing real assets, a warning that paper promises are being questioned, a warning that leverage has limits. And banks know this. That is why they are not celebrating. They are not confident. They are managing survival. So if you hold silver, physical, ETFs, miners, or futures, understand where you stand in this chain. And if you don't, you should still pay attention, because silver does not move alone. When it screams like this, something bigger is shifting underneath the global financial system. And by the time everyone agrees on what that shift means, the opportunity and the danger will already be priced in.